Today's highlights: Bitcoin drops below $90,000 without a major news trigger as Fed disagreements and minor pressure mount. Will Bitcoin test new lows and erase its gains for the year? Why does Michael Saylor keep going head-to-head with Peter Schiff? The US is making a full push on crypto regulation bills. If it misses the 2026 window, will Europe overtake it? Thursday, October 20th on TV Chinese Channel B, this is Dong Dong. First, let's look at the most important data from the past 24 hours in the crypto world. The headline is the latest Fed meeting minutes. Once released, the market sentiment immediately collapsed. There was fierce internal debate among officials. Some want to cut rates, while others are stubbornly holding on. Loosening policy now would be far too risky. As a result, market expectations for a rate cut in December have dropped from over 50% to just 32.8%. And right at this moment, US labor market data is about to be released. If the unemployment rate even wobbles a bit, it could send the entire market's mood into chaos. The US stock market has also been sluggish these past few days, and Bitcoin is following its lead. When US stocks open weak, Bitcoin drops along with them. When the US market is closed, it quietly tries to climb back up. Right now, the entire market is fixated on that crucial $90,000 line. But with the macro environment so unstable, even the slightest disturbance could trigger a sudden reversal. Before the data is released, Bitcoin will most likely keep fluctuating between $90,000 and $94,000. If you want a breakout, you'll have to wait. The Federal Reserve needs to give a clear signal. This time, Bitcoin has dropped all the way from $110,000 to $90,000, which looks terrifying. But the reality on the blockchain is far from doomsday. Almost none of the big holders have sold. The total holdings only dropped from 16.605 million coins to 16.66 million coins, which basically means there was almost no movement. Retail investors only sold about 2,700 coins, not even enough to make a ripple. The real damage to the market was done by those fast-moving short-term traders on the exchanges. The spot CVD flashed a red alert and perpetual traders kept selling as the price fell, with the liquidation chain triggering one after another, driving the market even deeper down. What's even more intense is that, over the past 5 days, miners have dumped 45,000 bitcoins onto Binance, basically slamming the gas pedal on the market. Overall, this isn't about capital fleeing. It's leverage scaring itself, with the structure still intact but sentiment way too fragile. Once the market finds its footing, the rebound could be much stronger than people expect. As for Bitcoin miners, lately their days have been as plain as a bowl of noodles. Their daily transaction fee income is minimal. There's only about $300,000 left, hitting a new low for the past year, and it's less than 1% of their total income. So what's really keeping them afloat? It's still that steady $45 million in daily block rewards. With things this quiet, it shows that on-chain activity has been frozen by the market correction. People aren't trading or speculating, and even the speculative mood has gone into hibernation. The network may be running smoothly, but life for miners is getting even tighter. After all, block rewards get cut every 4 years, and if transaction fees stay this sluggish, the future really doesn't look promising. Overall, the on-chain activity is cold right now, but cold also means a turning point for warming up is coming. As soon as transaction fees start to spike, that's often a sign the market is about to recover from its scare. Please like and follow for the latest updates from the crypto, blockchain, and mining worlds, brought to you 24/7. Click the little bell and join the channel to become a member. From Monday to Friday, receive exclusive wealth codes for members. BlackRock's IBIT really took a hard fall this time. On November 18th alone, $523 million flowed out in a single day, which is equivalent to dumping 5,630 bitcoins all at once. This set a record for the largest withdrawal in history, although the remaining assets still amount to $72.76 billion, firmly securing the top spot among Bitcoin ETFs. This sudden mass exodus inevitably raises doubts about whether investors are starting to lose patience with BTC ETFs. To make things even more awkward, as soon as Bitcoin drops, MicroStrategy's Stoto label gets dragged out for scrutiny all over again. Can this wave still hold up?
Data shows that MicroStrategy currently holds about 649,000 bitcoins, with a total value exceeding $59.6 billion. That is, its MNAV since Bitcoin hit $125,000 in October. After reaching a historical high, it dropped from 1.52 times to 1.11 times. In terms of stock price, MST2 has fallen 30% in the past month and is down 50% over the past 6 months. But Michael Saylor has not wavered due to the market correction.
Drawdowns, they've always eventually come back to reach a new all-time high if you zoom out and look at the bigger picture. This is just par for the course in these markets. This is completely normal in the overall life cycle of an emergent transformational asset class, and it's something we've seen time and time again.
Saylor's optimistic remarks quickly drew sarcastic criticism from his old rival, gold bull Peter Schiff. Once again, he called Bitcoin a bubble and accused MicroStrategy of being a fraudulent company, claiming that its preferred stock yield is unsustainable. He even suggested that the company could eventually go bankrupt.
It's going towards zero right now, which is extremely robust.
This week, Bitcoin took a beating and wiped out all its gains, but MicroStrategy's Saylor wasn't fazed at all. He countered by saying the market has it all wrong. Others think Wall Street's arrival means a sell-off, but he believes this is when Bitcoin is finally starting to act like an adult. He even brought up old stories. Back in 2020, when MicroStrategy first bought in, volatility was at 80%, like riding a rocket. Now it's dropped to 50%, much more stable. He even predicts that Bitcoin's volatility will keep decreasing in the future. Eventually, it'll be just a bit higher than the S&P 500, but with even better returns. In short, institutions aren't here to cause trouble. They're here to help Bitcoin grow up. Late autumn in Washington is chilly, but Capitol Hill is even more tense than the weather. Senate Banking Committee Chairman Tim Scott made it clear the crypto regulation bill must get through the committee before Christmas. Otherwise, once next year's presidential budget is released, the bill could get drowned in political infighting. According to his timeline, the full Senate would vote on it in the spring of next year, and by 2026, it would be sent to Trump's desk for his signature, fulfilling his campaign promise to turn America into the crypto capital. The House has already passed the Clarity Act, so now all the pressure is on the Senate. This legislative countdown feels just like a ticking time bomb.
The core of the crypto regulatory bill is to redefine the boundaries of regulation. The CFTC will take the lead in overseeing the spot market for digital commodities. The SEC will continue to regulate offerings that are clearly classified as securities. The biggest breakthrough is the introduction of the concept of ancillary assets, which, while possessing some securities characteristics, provides a compliant pathway for tokens in a transitional phase of decentralization, allowing innovative projects room to grow. Although both sides have fiercely debated the DeFi anti-money laundering provisions, the core framework has already taken shape.
For the big players on Wall Street and in Silicon Valley, what really gives them the confidence to invest isn't talk about the next bull market, but a set of clear and explicit regulatory rules. In the past, the US regulatory approach relied on the mysterious art of enforcement, which scared a bunch of institutions into inaction. Now, once the bill is passed, everyone from futures brokers and investment banks to pension funds will be able to enter the market openly and legitimately. As one fund manager put it directly, as long as it's confirmed that the CFTC is taking the lead, all the capital we've been holding back can be unleashed at once, like opening the floodgates of a reservoir. On the flip side, if the US drags its feet until 2026 without getting things in order, places like Europe, the MSCA, Singapore, and Hong Kong will attract all the global incremental capital. By then, even the US dollar's pricing power over digital assets will be diminished. Don't be fooled by all the current hype in Washington. What really determines the market isn't the candlestick charts, but the yes or no buttons inside Congress.
Here, there are legends of overnight riches, as well as carefully woven scams. This is a dark forest of chaotic development, but it also nurtures the spark of hope that leads to the light. The destination of faith is freedom, and the endpoint of consensus is equality. BitcoinTV, guiding you through the fog to see the future and helping you gradually become wealthier together.
A new law is in place, but there are no licenses. With Bitcoin ATMs entering Kenyan malls, what is the path to compliance? 3 S-curves reveal the future of crypto. The variant report shows that capital utility is becoming the new hotspot. Just a few days after Kenya finalized its crypto regulatory framework, reality has already pressed the stress test button. Suddenly, a Bitcoin ATM labeled Backlash Bitcoin appeared in a major mall in Nairobi, with some machines even boldly placed right next to traditional bank counters, allowing people to directly exchange cash for cryptocurrency. It's like opening a branch right at the bank's doorstep. But to be fair, this isn't the first time Kenya has seen something like this. Back in 2018, B Club quietly installed a few machines as well, but at that time, no one used them. They weren't qualified to make it to such a big stage. This time, though, they debuted right on the main stage, which startled the Central Bank of Kenya, CBK, and the Capital Markets Authority, CMA, so much that they quickly issued a joint statement to put out the fire. Everyone, please calm down. We regulators haven't even finished warming up yet.
It revolutionized. Did it really enable cross-border trade? In a way never seen before, because transactions on the blockchain, for instance, are instant T+0, unlike other transactions in conventional banking sectors where you might have to wait up to 3 days.
The Central Bank of Kenya, CBK, and Capital Markets Authority, CMA, have jointly stated that no licenses have yet been granted under the new law to any virtual asset service provider, VSP, to operate in or from the country. All so-called approved crypto services are illegal. The issue stems from a regulatory gap following the implementation of the new law. On October 4th, Kenya officially implemented the Virtual Asset Service Provider Act, which stipulates that the central bank is responsible for payments and custody, while the CMA is in charge of investment and trading. However, the crucial VSP licensing process has yet to be announced. Crypto industry players find themselves in an awkward position, wanting to comply, but with no way to do so.
While Kenya's regulatory framework is still being laid out, ordinary people have already jumped in. Bitcoin ATMs appearing in shopping malls are just the appetizer. The real hotspot is in communities like Kibera, where incomes are tight. People there have already started treating Bitcoin like a portable wallet. There's no need for a bank card, no waiting in line, no forms to fill out, just pull out your phone and you can deposit money. Co-founder Ronim Davida put it quite realistically, local residents can't even manage regular savings. For people who live on just $1 a day, Bitcoin really does feel like a kind of freedom they can actually grasp. But the problem is, as the crypto ecosystem keeps growing more and more vibrant, the regulatory framework still has holes that haven't been patched. How can you keep the market lively and thriving without letting everyone's money take a nosedive? This has become the biggest headache for Kenyan regulators. Alana Levin, a partner at VeryFun, recently released a trend report on this. He breaks down the crypto industry into asset creation, asset accumulation, and asset utilization, analyzing them through 3 S-curves. After looking at it this way, you really get that aha moment. The so-called asset creation phase is basically a wild party where everything can be tokenized. Ever since Bitcoin burst onto the scene in 2009, Layer 1s, NFTs, stablecoins, and meme coins have taken turns in the spotlight. The total number of tokens has skyrocketed from 20,000 to several million. It's like someone hit the turbo button. Although everyone is still tinkering with things like putting real-world assets on-chain, the door from 0 to 1 was already blasted open long ago. Looking back at the past decade or so, the imagination and explosive growth of the crypto industry have truly outpaced even the wildest ideas.
The industry is now entering a phase of rapid expansion in asset accumulation. The richer the variety of assets, the stronger the demand to hold them, which in turn drives explosive growth in foundational infrastructure like custodians and exchanges. Custody solutions are now showing a layered structure. Whether it's established giants like Coinbase, traditional fintech platforms like Robinhood, or emerging service providers, all are experiencing rapid growth. More importantly, publicly listed companies and sovereign wealth funds have also begun to formally allocate crypto assets. This level of institutional recognition was almost unimaginable just a few years ago. At the same time, the period of asset utilization has just begun, and the high composability of crypto assets is coming into play. Programmability is giving rise to more real-world use cases. Applications such as stablecoin payments, on-chain lending, and liquidity provision have already been implemented. But this is just the beginning. There are still many ways to utilize assets waiting to be explored in the future.
The 5 major sectors in the report are quite interesting. Mainstream crypto assets are growing, and leading assets market cap positions have stayed stable. Stablecoins' growth is even more remarkable. They've flourished across issuance, fiat on-ramps, and applications. Centralized exchanges have benefited from asset accumulation. Trading volume has surged, and their business scope has expanded. The on-chain ecosystem remains much the same as before. Innovation is happening at such a rapid pace that it just can't be stopped. All kinds of new economic models are sprouting up. Looking at the big picture, these 3 curves are like steps, gradually pushing the crypto industry from wild, unchecked growth toward maturity. Watching assets go from being created to being accumulated and then to being utilized, you can really feel as if the industry is alive. In the future, innovations centered around asset effects will definitely keep booming, and there are sure to be plenty of surprises.
Market sources indicate that Trump has set the time window for deciding the next Federal Reserve Chair before Christmas. This decision could introduce new uncertainties regarding the future path of interest rates and macroeconomic expectations. At DEF Connect, Vitalik issued a warning that quantum computing could break elliptic curve cryptography before the 2028 US presidential election and called for Ethereum to complete its migration to quantum-resistant cryptography within 4 years. Ripple CTO Davis Trends is promoting an entirely new staking design aimed at upgrading the XRP ledger's mechanism structure and security system. If implemented, this would open up a new technical path for the network. According to the latest data from Bank of America, tech stocks have seen capital outflows for the 5th consecutive week, highlighting a continued decline in market confidence and a clear cooling of risk appetite in this sector. Official sources indicate that Kraken has submitted a draft S-1 registration statement to the U.S. Securities and Exchange Commission, planning to issue common stock, though the specific number of shares and price range have yet to be determined.
Today in the auditorium, we often think that sincerity is a key that can open everyone's heart. But in reality, we are repeatedly proven wrong. Sincerity is not all-powerful. If you give it to the wrong person, it only becomes a cheap offering. The more seriously you treat it, the more others take it for granted. Those moments when you suddenly become a bystander are not accidents, but answers. In that instant, you finally realize that the importance you imagined for yourself was just wishful thinking. What you thought was an exception was, in fact, just a casual afterthought in the world. What you thought was special was just your own wishful thinking. True maturity is when we can pull back our excessive enthusiasm and give our overflowing kindness to those who truly deserve it. Being clear-headed isn't being cold, it's a form of self-protection. Don't just move yourself to tears, that too is a kind of growth. Some people don't fail to cherish you, they just forget to because you gave too much. If you understand, please give a like. Alright, that's the main content of today's program. Our channel focuses on valuable news in the crypto, blockchain, and mining circles. We provide news updates as well as in-depth special reports. If you find our channel valuable, feel free to share and follow us. You can also become a member. From Monday to Friday, members can receive exclusive wealth tips. Let's add a zero to our assets in this bull market. See you tomorrow!